You work hard for your money day in and day out, putting in the hours to earn a living. It represents your time, your effort, and your dedication. But if it just sits idly in a savings account, slowly but surely, inflation eats away at its value, like a silent thief. The purchasing power of your savings diminishes over time, meaning you can buy less with the same amount of money. Instead, investing lets your money grow. It's a proactive way to combat inflation and build wealth. Think of it as putting your dollars to work, giving them a job so they can earn even more dollars for you, generating passive income and increasing your financial security. By owning a piece of companies through stocks or funds, you become a part owner of these businesses, sharing in their success. You benefit directly as those businesses grow, expand their operations, and increase their profitability. Your investment grows alongside them. The earlier you start investing, even with small amounts, the more time your money has to compound and multiply, benefiting from the power of compounding returns over the long term. This can significantly boost your wealth over time. You don't need a lot of money to begin your investment journey. Just a few dollars, and the willingness to start. Even small, consistent investments can add up significantly over time. The real question isn't if you should invest, because the benefits are clear, but how you should invest to align with your goals and risk tolerance. That's where mutual funds and ETFs come in. They offer accessible and convenient ways to participate in the market. Both offer easy ways to diversify your investments across a range of assets and grow your money in a more balanced way. Instead of betting all your money on one single stock, which can be risky, you buy a basket of investments, a collection of different stocks or bonds bundled together. Spreading out your risk across multiple investments helps to cushion the blow if one investment performs poorly. Let's break down in more detail what mutual funds and ETFs are, exploring their key features and differences, and determine which might be the right investment vehicle for you, based on your individual circumstances and investment preferences. Let's break down what a mutual fund really is. At its core, a mutual fund is essentially a pool of money, a collective investment vehicle. This pool is formed from the contributions of many individual investors, each looking to grow their wealth. The fund is then expertly managed by a professional fund manager, a seasoned expert who carefully picks stocks representing ownership in various companies, bonds, which are debt instruments or other diverse assets for you, aiming to maximize returns while managing risk. When you invest, you buy shares of the fund, becoming a part owner of this diversified portfolio. Importantly, you don't directly own the individual investments inside it. Instead, you own a piece of the entire fund. The price per share, called NAV, or net asset value, is meticulously calculated and set once a day, typically after the market officially closes. It's crucial to remember that mutual funds charge fees, often expressed as expense ratios, to cover the costs associated with management, research, and day-to-day operations. These seemingly small fees can gradually eat into your overall returns over time, impacting your investment growth. Therefore, it's incredibly important to carefully pay attention to them and understand their impact. In short, mutual funds offer the significant advantages of professional management and built-in diversification, but often come with the trade-off of higher costs compared to other investment options. ETFs, or exchange-traded funds, are similar to mutual funds but trade like stocks on an exchange. You can buy or sell them anytime the market is open, and their prices change throughout the day. Most ETFs are passively managed, tracking an index like the S&P 500, which keeps costs low. Lower fees mean more of your money stays invested and compounds over time. ETFs offer instant diversification, flexibility, and are accessible to nearly everyone. That's why they've become so popular with new and experienced investors alike. Let's compare mutual funds and ETFs head-to-head. Understanding the differences between these two popular investment vehicles is crucial for making informed decisions about your financial future. We'll break down key aspects to help you decide which might be a better fit for your investment goals and risk tolerance. Mutual funds are bought at the end-of-day price. This means that your order is executed after the market closes, at a price that's determined based on the fund's net asset value, NAV, at that specific time. You won't know the exact price you're paying until after the transaction is complete. Mutual funds often have higher fees which can eat into your returns over time. These fees, known as expense ratios, cover the costs of managing the fund, including salaries for fund managers and administrative expenses. Mutual funds may also require a large minimum investment, potentially making them less accessible to investors with limited capital. Some funds require thousands of dollars to get started. ETFs, on the other hand, can be bought or sold instantly during market hours, just like stocks. This intraday trading flexibility allows you to react quickly to market movements and adjust your positions as needed. ETFs usually have lower fees compared to mutual funds, making them a more cost-effective option for many investors. The lower expense ratios can significantly boost your long-term returns. And with ETFs, you can start with just a few dollars, thanks to fractional shares offered by many brokerages. This makes them highly accessible, even if you're investing on a tight budget. For example, a mutual fund might charge 0.75% per year, meaning that for every $1,000 invested, you'll pay $7.50 in fees annually. While a similar ETF, tracking the same index, could charge just 0.05%. That's only 50 cents per $1,000 invested. Over time, that fee difference adds up significantly, especially with the power of compounding. Even seemingly small differences in fees can have a substantial impact on your investment returns over the long run. Ultimately, lower fees mean leaving more money in your pocket with ETFs, allowing your investments to grow faster and reach your financial goals more efficiently. Mutual funds offer professional management, where experienced fund managers actively select and trade securities with the goal of outperforming the market. However, it's important to note that most managers don't consistently beat the market, and their expertise comes at a higher cost. Many actively managed funds underperform their benchmark indexes over the long term. ETFs are easy to access, especially with fractional shares, which allow you to buy a portion of a single share, making it easier to diversify your portfolio even with limited funds. This accessibility and affordability make them ideal for beginners who are just starting their investment journey and want to learn the ropes without risking a lot of money. In short, ETFs are generally cheaper, offer more flexible trading options, and are more accessible to a wider range of investors. Mutual funds may appeal if you want active management and believe a fund manager can consistently outperform the market. But remember, this comes at a cost, and you shouldn't mind higher costs. For most people, especially those focused on long-term investing and building a diversified portfolio, ETFs are often the clear winner, providing a cost-effective and efficient way to achieve their financial goals. So which should you choose? For most beginners, ETFs are the best option. They're low-cost, easy to buy, and give you broad market exposure. Mutual funds might make sense if you want a manager picking investments for you, but the higher fees rarely pay off. Decades of research show most active managers don't beat the market. Start with a broad market ETF like an S&P 500 or total stock market fund. Set up automatic investments and let your money grow. It's simple, effective, and affordable. That's how you build real wealth over time. Thanks for joining us. Don't forget to subscribe and watch the next video for more helpful tips.